Stephanie Link, what just happened? Why the huge reversal here, particularly because we're seeing not just the mega cap tech stocks do well in the NASDAQ, we're also seeing the quote unquote lower quality innovation names do well. ARC, for instance, is up about 5% today.
Well, I think also you have the reopen names that are doing really well after the mask mandate. And some of the airlines from the TSA were lifted. So I think that's encouraging to some degree. I also think the housing numbers, even though on the face they were strong, underneath it was all multifamily. So maybe the housing market is not as hot. Maybe the economic data continues to be mixed. Maybe the Fed doesn't have to go as much. I mean, Bullard was crazy today saying maybe 75. Maybe that means he wants to get, and they want to get ahead of the curve because we know they're behind the curve. But, you know, we've been talking a lot all year long, Melissa, about all of these unknowns, right? And that it's going to be a choppy market because of the unknowns with war, with inflation, with the Fed. That's the reason why the market is down. The S&P is down 7% year to date. That being said, I was really encouraged by the banks and what they had to say, the big six, last week and then yesterday. And what they said mainly was the consumer is hanging in and they're really strong. In fact, J.P. Morgan said the consumer is in extraordinary good shape. So to me, that's encouraging. And they talked about jobs and wages and savings and all of that. But they also then talked about how there's a shift more towards services, reopen. Why is that important? Well, A, the consumer is 70% of the economy. And B, services is 70% of U.S. consumption. So we are rooting for the consumer. And from what we're hearing from the banks, they're fine. They're better than fine. So what does all this mean? Mid-single digit, upper single digit earnings growth this year. That's supportive for stocks. I have said you want to be balanced between cyclicals and quality growth. I have been leaning more towards buying quality growth on the pullback because, you know, I have been on the cyclical side. I'm really encouraged by the reopening names as well. So there's a lot to choose from here. I don't think you have to pay up and chase by any means. Stay patient and be valuation sensitive.
Yeah, Diamond's had an underbelly of caution in his commentary, but certainly Bank of America's Moynihan was very bullish when it came to the health of the U.S. consumer. That was yesterday morning. Jason Snipe, what's your take on what is happening in today's session? I mean, we had Bullard yesterday float that idea of 75 basis points, one hike of 75 basis points, and the market's okay with that.
Yeah. Yeah, Mel. So I guess what I would start by saying is obviously last week we got a slew of macro data. Obviously, we saw a CPI number that was in line. We saw a PPI number that was explosive. But when we go back to core CPI, which was a little lighter than expected, which is led by pullback in used car sales, even as we look at durable goods have declined some. You know, and I'll go back to what Steph's point just made on financials and the state of the consumer. The consumer is still healthy at this stage. So I think these are all positive sentiments going forward. Let's see if the market could do some of the work, you know, and easing some of the supply chains, which obviously will be beneficial for a number of sectors. So I think there is some light at the tunnel and possibly, you know, inflation, you know, potentially topping out here. Maybe it's likely it will continue to persist, but maybe we don't see any higher numbers from here. And I think those are all positive tailwinds for the market going forward.
Yeah, I don't want to get all bulled up on one session here, Jim Lebenthal, and to put in perspective, the NASDAQ is still off just about 17% from its highs. And we are just on the precipice of earnings season. What we've gotten so far is sort of a mixed bag. So what's your take on how we're positioning ahead of what could be very consequential when it comes to the guidance companies give, especially as the dollar? This is something that you know we talk about, but the impact of the dollar could be huge for multinationals this quarter. And it'll be interesting to see what companies say and how they navigate that guidance.
It's certainly what they say, and not just the guidance on the dollar's impact, but the guidance on the war, the guidance on, margin pressure from inputs going up. And I think you're right, Mel, to start off by saying, you know, one day does not a rally make. But I'd also like to put a little perspective here. We were in a rally mode until about 2.5 weeks ago. And in that 2.5 weeks, just looking at the S&P 500, which I like to because it's broader than the NASDAQ, we're off about 4% from that peak of about 2.5 weeks ago. So it's not a crisis mode. It's not a moment to say, oh, my goodness, we're in a bear market and the rally's over. But there is a tug of war in the markets going on right now. And it's between a very aggressive Fed on the one hand, very aggressive, as witnessed by Mr. Mr. Bullard yesterday, and earnings, which, as you rightfully pointed out, we're just on the very cusp of. We had 8% of S&P 500 companies report so far, so that's just not enough to hang your hat on. But so far, 79% have beat estimates, which is close to the historical average. And at least over the last week, you've seen aggregate S&P 500 earnings estimates tick up again, albeit by a little bit. The main point of this is it's too early to hang your hat on earnings, but the initial indications are good. This week is going to be very, very important. And the next 3 weeks are going to be important because that's the heart of earnings season. That could be enough to overcome a very negative Fed or very aggressive Fed, particularly when the S&P 500 is off about 9% from its January high, meaning a lot's already priced in on the downside.
You know, Jim raises an interesting point in terms of the S&P 500 and how far off of its high it is. It isn't that far off, actually, Dr. J, even though it feels worlds away. We're off under 8% from its 52-week high. In your mind, does that make you feel better or worse? Worse in that maybe there's more damage that needs to be done on the S&P 500 because we haven't priced enough in.
Well, Mel, I was just looking at that structure for the VIX. And looking at that, if you look just at the spot VIX, in other words, the second-by-second trading VIX, that is basically under 21. You would say, well, pretty nice drop today. People must be feeling pretty bullish. And obviously the markets are higher. But you look out the curve and you look at it, Mel, out into June, and it's north of 25 still. That's telling me that there's a lot of uncertainty, potential for volatility out there in the June, July timeframe for sure. And what does that mean? That means, okay, we're getting through this early earnings cycle right here, but out the curve, not nearly as bulled up as some of the short-term moves may tell people. So I would say that we haven't sounded the all clear. It's nice that the market is able to trade up in the face of these much higher interest rates. I suspect a decent amount of that is also the mask mandate that Steph mentioned, how good that is for the reopening, as well as crude oil coming off by better than 4%, I think, today. I think those two factors are pretty significant in the short term, but won't be nearly as significant out there 3 and 4 months into the future.